The U.S. stance on Russia and its possible invasion of Ukraine.
I've been absolutely clear with President Putin. He has no misunderstanding. If any assembled Russian units move across the Ukrainian border, that is an invasion.
Yesterday, Biden said a, quote, minor incursion by Russia into Ukraine would be met with a less forceful response from the U.S. and its allies. Well, President Biden is marking his first year in the White House with approval ratings at new lows. Bloomberg's Amy Morris has more from Washington.
The poll from the Associated Press Nork Center for Public Affairs Research shows a majority of Americans, for the first time, disapprove of how the president's handling the pandemic and inflation, 56 to 43%, with a margin of error of 3.8%. Compare that to July, when 59% of Americans said they approved of Biden's job performance. But now only 28% of Americans say they want him to run for re-election in 2024, including only 48% of Democrats. In Washington, I'm Amy Morris, Bloomberg Radio.
A report into child sex abuse in the German Catholic Church says former Pope Benedict knew about abuse and failed to take action when he was Archbishop of Munich. The inquest into the German Catholic Church has found that Pope Benedict, then called Joseph Ratzinger, was told about the facts of 4 separate cases of child sexual abuse and that he allowed the alleged perpetrators to remain active in church roles. Ratzinger has previously denied that he knew of the abuse. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Katie Greifeld, Carol Masser, we are Bloomberg Business Week on this Thursday, this Friday's Eve. I got to say, you shared this with our producer, Ariagami, and this is like perfect. I can see you like, oh yeah, I love this story. Tell us what's going on.
Okay, so this is a story from yesterday. For my day job, I comb through a lot of ETF filings. There's not many that I find absolutely delightful, but this was one of them. So we had a filing yesterday from Direxion. They are an ETF issuer, and they filed an application with the SEC for the Direxion Breakfast Commodities Strategy ETF. Adorable. So what this fund will track is coffee, orange juice, wheat, and lean hog futures. Basically everything that you could want in a breakfast. You are missing eggs there, but pretty comprehensive. This is definitely one of the more fun filings I've seen in a while.
They could call it the Lumberjack Breakfast ETF as well. Why are they doing this? Like, I do love how investment firms kind of dice and slice the markets, but was there demand for this? Like, why? What's particular about doing it this way?
That's what my editor asked, because I flagged it. I was like, oh my gosh, this is adorable. He was like, what is this?
Why are they doing this?
Like, what is the investment case here? But it is a play on inflation, truly, because, I mean, especially in the commodities, in food prices, you've seen prices really skyrocket. For those investors looking to maybe get exposure to that, I mean, this is a pretty comprehensive look at what at least a lot of America eats for breakfast. And I mean, we know that coffee prices, for example, have just been on fire recently.
Where's my bagel? Where's my yogurt? Where's my blueberry ETF? Come on.
In our ETF chat on the print side, this did, was a lot of quibbling over what's missing here. But I mean, you've got coffee, lean hog, that's some pork belly in there.
Pop-Tart ETF, could it be just around the corner?
I want to know when I'm going to get a high-fiber English muffin ETF. That one is not on the way, at least that I know. Any ETF issuers listening?
Don't hold your breath. It is interesting, though, right, when we see all this food inflation, and so this is just different ways, I guess, of really kind of keeping track of it, or investors playing it.
And ETF issuers, they have to stand out. This is an eye-catching package here.
All right, you're listening to Bloomberg Radio.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell. Right to the numbers. It has been a trying day for the bulls, with the S&P now down by 31 points, down 0.7%. The Dow is down 163 points, down 0.5%. NASDAQ lower by 125 points. The NASDAQ Composite Index now down by 0.9%. For the month of January, NASDAQ is now lower by 9.2%. 10-year up 12.30 seconds. 10-year yield 1.82%. Spot gold down 0.1%. 18.38 the ounce. And West Texas Intermediate crude down 0.1%. 86.90 a barrel on WTI. Bitcoin up 2.2% right now. 42,625 on Bitcoin. All of the selling really coming beginning at just about 3 o'clock Wall Street time. Stocks ticking lower, mirroring late-day moves this week as investors cut holdings in riskier assets. To be sure, NASDAQ now down by 130 points, down 0.9%. S&P down 0.7, 10-year yield 1.82%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. It is 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
When he took office 1 year ago, President Joe Biden faced extraordinary challenges: a global pandemic, a teetering economy, and bitter partisan divisions. How has he done? The economic recovery during his first 12 months has been impressive, to be sure. Output has rebounded, and unemployment has fallen to less than 4%. But Biden has also disappointed in important respects. The gravest threat to the nation now is not COVID-19, but the possibility that America's creaking machinery of government might break down altogether. The president's most important job is to restore some semblance of national unity. Unfortunately, Biden hasn't tried hard enough to push Democrats and Republicans to work together. The president needs to remember that he promised to move on from Trump's poisonous politics and start mending the country's divisions. That's why he was elected, and no task is more important. This editorial was written by the Bloomberg Opinion Editorial Board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
It is time for the drive to the close. With us is Ben Kirby, co-head of investments and portfolio manager at the independent global investment management firm Thornburg Investment Management. They have $49 billion in client assets. Ben joins us on the phone in Santa Fe, Mexico, which is where the company's based. So what I really want to know is, do you run into Julia Roberts?
Yeah, she lives. She has a place here in New Mexico, so absolutely, big fan.
Okay. No, let's get serious. It's been a tricky day in terms of the markets, and I think we're trying to figure out, are we settling in, or this is just the volatility everybody's been talking about as the market recalibrates itself. Ben, how do you see it?
Yeah, well, thanks for having me on the show. I mean, look, I think that the volatility today is just an indication of what's going to come for the rest of the year. There's a lot of cross currents, and we have, a very strong economy, but we also have, tightening monetary conditions, and I think we're going to have a lot of chances to pick stocks and a lot of chances to either add value for clients or destroy value in the next few months.
Well, Ben, let's name some names. Where do you position yourself, maybe hide yourself from some of that volatility in this environment? What do you like right now?
So I like strong, dominant companies. I think the place you don't want to be right now is in companies that are losing money or companies that are, really investing all of their gross profits, trying to gain market share and trying to do a land grab. So focus on companies that are durable, that are strong, that have cash generation, that have moats around the business. A few names I guess I would highlight within semiconductors. We like Broadcom and Taiwan Semiconductor. We can talk about those two strong, dominant companies that are generating a lot of cash flow, that are growing, that have dividends. I think that's generally where you want to be. Similarly, within energy, I think you want to pick, some names that have some secular growth, but also that have a lot of cash generation. So something like a Total Energies in France is another big holding in several of our portfolios.
Well, it's interesting too. I'm so glad we're talking with you because we've got a story in the magazine. We're talking about Eric Schatzer had a conversation with Jeremy Grantham, who's calling that, saying that we're in a super bubble and we're going to see basically a super bust. But there are people saying it's time to look at your portfolio, that the U.S. has had some incredible gains and it's time to start looking overseas. How do you see that as well, the U.S. versus the rest of the world?
I think there's a good argument for that. Certainly, valuations are a bit lower outside the U.S. The rest of the world is not as far in the economic cycle as the U.S. So the U.S. is going to be hiking rates aggressively. Inflation is definitely more of a concern in the U.S. than it is in Europe and the emerging markets. So simple economic cycle positioning, I think there's a good argument for international companies. I think more than that though, it's that sort of super bubble concept versus a super bust. There's actually a lot of companies that are not in a super bubble. So I mentioned Total. This company is trading at a single digit PE. It has a 5% dividend yield. It has a 9% free cash yield. That's not a bubble. That's actually a very attractive, reasonable valuation. Similarly, something like Broadcom that I mentioned, trading at a mid-teens PE. So there are bubbles out there. As an active manager, our job is to avoid those bubbles and to find the places that still have a lot of value.
And Ben, in thinking about the volatility that we're seeing, and to your point that perhaps this is just a preview of what's to come, how does the Fed and their plans play into this? How much of this volatility that we are seeing and are yet to see, how much can we blame the Fed here?
I think we can blame the Fed a lot. It's going to be really the debate right now is, are we going to have a soft landing or a hard landing? But we're going to have some kind of a landing. So soft landing can be that, stocks are volatile, but maybe they end the year at a similar place where they are today, maybe even up, mid-single digits. Hard landing is we're going to get a 20% correction at some point, in this year. Overall, I think the Fed is late. The Fed is behind the game. They're raising rates, trying to catch up, or they will be soon. There's still a lot of time left on the game clock this year, so we'll have to see how things play out.
I think it's fascinating what you just said. Katie, I just think about the Grantham story with Eric and this whole idea that, there's some that have just had such a tremendous run-up, but as we're just hearing right now, that's not the case for every name that's out there. So, Ben, let's talk a little bit more about some of the names that you like and fundamentally why you like it. On that list, and correct me if I'm wrong, are some big U.S. financials, right? Like a J.P. Morgan or a Visa.
Yeah, absolutely. So J.P. Morgan really fits the bill for one of those durable companies that's not going to go away. Over the last 5 years, J.P. Morgan has grown their earnings per share at a 15% rate, and the S&P has been 13%. So here's a big bank that's grown faster than the market. Over the last 10 years, they've grown earnings at 9% compounded, and the market is 8%. So the market includes all these big tech names, all these companies with much higher valuations. J.P. Morgan has outgrown the market for 5 and 10 years. It trades at a PE of 12 versus the market at 20. It has a dividend yield of 2.7%. So you kind of put that all together, and look, there's going to be volatility in J.P. Morgan as rates go up and rates go down, as we sort of price in consumer credit and other drivers of big financials. But the big picture is you have a growth entity here with a dividend trading at a massive discount to the market.
And Ben, to circle back on what you said about, you're interested in companies that are earning money right now, that, do have strong, financials. Does that mean you're avoiding growth stocks? How does tech look in this environment to you?
Speculative tech looks tough. And we've been saying that for a while. So technology companies that are really trying to enter new markets, companies that might only have one product and they're, really having to spend aggressively to try to get market share. The capital markets are closing to those companies. They have been able to raise debt, raise equity at really attractive rates, and funding is just getting a lot more challenging. So those companies that have no earnings have gone down a lot this year. They're essentially trading like 100-year bonds, and they should. Within tech, though, there are still a lot of places that are, good quality companies that have interesting free cash flow. So I mentioned Broadcom. We also like Google. So big dominant companies with good balance sheets, structural growth. They may not be the flavor of the month right now, but over time, their long-term competitive position is undiminished, and that's really what we're looking for as fundamental investors.
Fundamentals, right? Balance sheets. This stuff really matters. Ben Kirby, thank you so much. Co-head of investments and managing director at Thornburg Investment Management, joining us on the phone from Santa Fe, New Mexico. And we say this on a day when we saw markets, they were up, but they are definitely off their best levels. In fact, trading lower across the board. Coming up next, we'll be joined by our Bloomberg TV team for Beyond the Bell, live on radio, TV, and YouTube. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline High, Taylor Riggs counting you down to that closing bell. And here to help take us beyond the bell, it's our global simulcast, joined right now by Katie Greifeld, filling in for Carol Masser, Tim Stenevik, also taking the day off. That brings together our Bloomberg television, radio, and YouTube audiences right now. We want to welcome in our entire audience because we got a lot to cover, a lot of ground right now. We are awaiting Netflix earnings after the bell, but right now, Katie, we have to talk about this sell-off correction territory for the NASDAQ 100. We saw it for the composite yesterday, and of course, the Russell moving even deeper into correction territory, down 17% from its all-time high.
Completely different picture than just a few hours ago. And what's striking to me is the volume that this selling is coming off of. If you look at the S&P 500 right now, volume about 25% higher than its 20-day average. That's on a day where about 437 stocks in the S&P 500 are about to close lower. So really a lot of volume behind this sell-off.
And Caroline, what's interesting is the jitters within the equity markets. You see a flight to safe haven when you're looking at full faith and credit. Bonds are catching a bid of 4 to 5 basis points. But as Richard was saying, it's the front end of the yield curve that is so stable. You're still at a 105 on the 2-year, as we are still looking at a Federal Reserve that might look at March for a hike, but don't forget, they're still buying bonds. It's January. They've 2 more months.
Meanwhile, the dollar absolutely crescendoing. We saw that reverse, got back into positive territory at around about 1:30. It's almost leading this market, now up 0.2%. So we do see all of these cross-asset moves work together in lineage today.
All right, we're going to walk through these numbers slowly for you as we await the closing bells here in New York City. The Dow Jones Industrial Average looks like it's going to finish the day down roughly by about 300 points as we wait for these numbers to settle. That's going to be down about 0.9%. The big reversal today was the S&P 500, was higher by about 1.5%. It's going to close down by about 1% on the day here. About 124-point move from peak to trough on the S&P 500. That's the second biggest point swing that we've had in basically a year and a half. The Russell 2000, which has been in correction territory now, going back to November, is now down 2% here on the day, more than 17% from its all-time high. And we have to talk about the NASDAQ indices. The composite yesterday closed down by about 10% from its all-time high. Now the NASDAQ 100 joining in. The NASDAQ 100 looks like it's finishing the day down on the day by about 1.3% here on the day.
Here comes Netflix. Fourth quarter earnings per share remain $1.33. Estimate was for 81 cents. The fourth quarter revenue, $7.71 billion. Bang in line with expectations. But as we find out that the NASDAQ 100 is indeed in a correction territory, you look to these big tech companies to see how they perform. And what you want to dig into, of course, is subscriber numbers. That's the all-important data for Netflix as we see their fourth quarter earnings per share coming in well ahead of expectations.
Yeah, and we should point out, too, I mean, if you're looking for Netflix to provide any sort of impetus for a rally or for a decline here, remember, it's not necessarily the heavy weighted in the index there. We're like 40th, I think, weighting in the S&P 500 shares down about 8% right now.
8.28 million.
Yeah.
8.28 million remain of estimated streaming paid net change. So that is shy of the expectations that Netflix put out itself, right? They were guiding for about 8.5 million of additions in overall subscriptions for the fourth quarter. And with the estimate from the street was just 8.13 million.
Yeah, and like we're getting some forecasts here for 1Q. Streaming paid net change 2.5 million. The estimate was 6.3 million. So that might be what. So they're guiding right now. So let's just put this in perspective, guys. 2.5 million net change subscribers for the first quarter. The street was looking for about 6.26 million. We should also say the company's saying that they're currently targeting operating margin of 19 to 20%, Taylor. This is a pretty big miss, at least to me, here on the surface. Want to see what Geetha Raghunathan thinks about this. She knows way more than about this than us. U.S. media analyst for Bloomberg Intelligence, jumping on the call right now. Geetha, what are we learning here? What's jumping out at you?
Yeah, so the guide, Romaine, as you just pointed out, that is definitely a big miss, because I think the street was kind of looking more at first quarter additions of about 6.2, 6.3 million, which would kind of then set the tone for the whole of 2022. We're looking more at like a 2.5 million, which really now kind of, I think, adds to a lot of nervousness amongst investors. And then again, if you look at the financial profile, the big story was that, you know, we were pivoting more towards profitability, with operating margin kind of increasing by 300 basis points every year. But it looks like that's again going to be a little bit lumpy, because they were looking at 20% for 2021 and then about 23, 24% going out to 2022. But it looks like that's remaining pretty flattish into 2022.
And Geetha, we spoke with you before this, and you were really looking at Squid Games, the success of that, the saturation of the U.S. market, what that means here for the international, the APAC region as well. They're saying coming out that Squid Game had 1.65 billion hours viewed in what I believe just 4 weeks or so. What is the success of that? What does that mean for the international subscriber base?
So, you know, Netflix now, it's really more an international subscriber story. If you just kind of look at the net adds over the past so many quarters, about 80-90% of all new subscriber additions come from the international markets. And of course, Asia Pacific has been just such a huge part of that whole growth story, just kind of given the fact that both broadband penetration continues to be low, as well as Netflix's penetration continues to be pretty low. It's about 15% in all of Asia Pac versus about 60% in the US. So there's tremendous upside there. So obviously, yes, there will be a lot of focus going forward, and it'll be interesting to see what management has to say today. They just recently slashed their prices in India by almost 60%. So we'll have to see if that's kind of going to be the tactic that they follow for a lot more of those emerging markets in order to kind of reinvigorate subscriber growth.
Yeah, we're speaking with Geetha Raghunathan, U.S. media analyst for Bloomberg Intelligence. We should point out Netflix shares are down about 11%. We should also point out that Roku shares, Disney shares, and a lot of the other streaming competitors also lower here right now in the post-market trade.
Yeah, Netflix loss is really accelerating post-market. Geetha, like you said, we are going to hear from executives pretty soon. That webcast kicks off at 6 p.m. Eastern. What could turn it around at this point? What could bolster sentiment? What do you want to hear from these executives?
So I think really what most of the market was looking for and what investors were looking for was kind of that 1Q guide number, so that it would set the tone for the rest of 2022. The fact that it came in so light, I mean, we really want to understand the reasons behind that. I think some of the factors that they mentioned in their investor letter were that, you know, the COVID hangover hasn't really lifted just yet. They're continuing to see weakness in some of those LATAM markets, but really want to get much more of a perspective there, whether this is just one-off, this is just some lumpiness that we're seeing, or whether this is really going to be the trajectory going forward. Because if you kind of just look at the content slate, it's been a monster content slate. And if that content slate can't do it, then it's going to be hard to, convince investors that this is really a long-term subscriber growth story.
Ethan, they're pretty much discussing exactly what you're talking about in the investor letter, saying that our guidance reflects back and weighted content slate in the first quarter. Bridgerton 2, our new original film, The Adam Project, isn't going to be launching until March. So are we looking at a lull that then picks up in the second quarter, given how back and weighted it is in the first quarter?
That can definitely happen. And we saw that actually happen, many times that this has happened when you have a quarter where everything kind of gets lumped towards, more of the second half versus the first half. You kind of then see that surge in subscriber numbers. And it could be just that. It could just be that they're trying to take a more conservative approach and they expect those numbers to kind of really pick up nicely as the quarter progresses. But really, I mean, we have to kind of, I think at this point, Netflix kind of really needs to convince investors that they are going to be able to get back to that trajectory of about 25 million subscriber additions, a year. That's kind of the magic number, the 25 to 30 million number, so that they are on that path to, the 300 million number by 2025.
They talk about competition, saying, look, it's only intensified over the last 24 months. They say, yes, it has increased some. and therefore affecting their marginal growth somewhat. But what do you want to hear in terms of the competition they see in many ways is gaming rather than the rival streaming platforms, Geetha?
Yeah, absolutely. I think more and more focus is going to now be on gaming, especially as you kind of see this slump in the streaming part of the business. I think investors are really going to want to hear from them something more concrete in terms of their gaming objectives. So we've already seen them they've debuted about 12 games or so on their platform. We've seen them go out and acquire some small independent studios. Night School Studio was one of them. But I'm not sure if that's really going to move the needle for them. So I think at this point, we'd initially kind of gone in with this thought that it would be more of a build versus buy, but I think at this point investors might really want to see them do something much more transformative in order to move that needle.
All right, our thanks there to Geetha Raghunathan. She's a U.S. media analyst for us here at Bloomberg Intelligence, helping us break down those Netflix earnings. Of course, the headline here, Katie, is basically that we're seeing the guidance going forward here for the current quarter, 2.5 million additions on a net basis. The Street was looking for 6.26.
Yeah, definitely a disappointment there. And shares just plunging after hours here. But like you said earlier, Romaine, not a huge weight on the benchmark. But if you look at the Q's ETF that tracks the NASDAQ 100, it is lower after hours, down about 0.4%. So it is having a weight on the broader index as well.
To their credit, Netflix addressing competition front and center, page 6 of the press release, saying we know consumers have a choice, but we still expect to grow, Caroline, in every region where a new product has been launched.
And can we just put into context how far they've already fallen? For them to be going down a 10% intraday, when put out the year chart that we've got on Netflix, when it peaked all the way back in November, we had, of course, a level of 691. We're now currently sub 500. This is a mighty crash.
Yeah, we're down 26% as of the close today from that all-time high back in November. You add in 10% tonight. And we should point out, too, that Netflix has a history of sort of falling the day after its earnings. It's done that in the previous quarters. In fact, 10 of the past 12 quarters, the stock has actually fallen the day after its earnings.
So history definitely against it. Not what Netflix needed to see today, though. It was already down 15% so far this year. There haven't been many days this year, and it's worth pointing out it was only up 11% last year, so it was already lagging the broader market. This has to hurt.
It has to hurt. But of course, amid the COVID run-up, this was a company that was trading at 254 back in September 2019. So still some lofty profits that you've managed to lock in if you're a shareholder.
And just another quick update here. Also, some of the competitors falling. Roku shares down about 5% here in the post-market. Disney shares down about 3%. So keep an eye on some of those names, Viacom, Discovery, if this is a broader trend or whether this is just something specific to Netflix.
A kickoff of tech earnings season, not looking too pretty. That does it for our cross-platform coverage of the market close on Bloomberg TV, radio, and YouTube. We'll be back tomorrow. Same place, same time, more earnings.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Certainly front and center. We're going to talk about that a little bit more in just a moment. But first up, we do want to get a check on world and national news. Nancy Lyons standing by in our D.C. newsroom. Hey, Nancy.
Thanks, Carol. President Biden is clarifying his comments from yesterday's news conference regarding Ukraine. Bloomberg's Irv Chapman has the latest from Washington.
The president redefined his comment about a possible incursion into Ukraine that was not a full-scale invasion.
Any assembled Russian units move across the Ukrainian border, that is an invasion. It will be met with severe and coordinated economic response. If Putin makes this choice, Russia will pay a heavy price.
The president said the Ukrainians should be confident of U.S. support and resolve. In Washington, Irv Chapman, Bloomberg Radio.
The House committee investigating the U.S. Capitol insurrection is asking Ivanka Trump, daughter of former President Donald Trump, to voluntarily cooperate with its investigation. They want to hear more about what happened at the White House January 6th. There are reports she encouraged her father to denounce the attack. A Georgia prosecutor is asking for a special grand jury to help investigate possible efforts by then-President Trump to interfere with the Georgia election. Fulton County DA Fannie Willis says this phone call Trump had with Georgia's Secretary of State Brad Raffensperger will be part of the probe.
I just want to find 11,780 votes, which is one more than we have, because we won the state
A special grand jury would have the power to subpoena witnesses. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Back to you, Katie and Carol.
All right, Nancy, thank you so much. Nancy Lyons in our DC newsroom. We got to talk a little bit more about Netflix because this stock is definitely down in the after hours. You were just talking with our TV colleagues, Romaine, Caroline, and Taylor. I mean, this stock has already been under pressure. But it's that outlook, and this is something, right, Katie, we talked to. We want to hear from executives about what's going on, and is this because of pandemic, lesser pandemic, or is it just Netflix has a lot more competition out there?
I think it has to be a competition or a combination of both, but definitely competition really heating up on the streaming front. It doesn't help that a lot of the new content that, you know, people were really excited about, it looks like some of that is going to get delayed until March. I'm thinking Bridgerton season 2, for example. I don't know if you watched the first season.
I did.
It was pretty spicy.
But they're going to miss an important actor, so I don't know if I'm as keen.
Yeah, you know, the enthusiasm has cooled somewhat, and it doesn't help that now that's going to be out later in the quarter, so a bit of a delay on some of the
But
big
this
names.
is a really good point. I don't know how you are. We're getting to a point where we went from cable, right, and all these add-ons, and now we just have a million different streaming services, and we start to reevaluate, well, wait a minute, am I really watching this anymore? Do I really want to be paying a monthly fee anymore? And it's all about content, right, and kind of moving around because of that.
Yeah, and I mean, just a big blockbuster. It's hard to come by. I mean, Squid Games is obviously huge for Netflix, but how many Squid Games are there?
I don't know. I've yet to watch Squid Games 1.0.
It's pretty graphic. I had to stop.
I don't know that I can go there. Hey, let's just remind everybody, the numbers coming out, what really did disappoint folks and investors and why you've seen the stock down around 10% or so in the after hours is Netflix seeing the first quarter streaming paid net change up 2.5 million. The street estimate way above that. That was for 6.26 million. So when you see an outlook like that, that is a mega disappointment. They're talking about first quarter EPS of 286. Katie, the estimate out there is for 337, so that too is way above. And first quarter revenue, they're looking for 7.9 billion. The estimate out there is 8.12 billion. Still making a lot of money, right? Or still at least selling a lot of service, but it's not exactly the optimism that the street saw.
Yeah, it's all about that rate of change, too. I mean, you're seeing that with really every company. That's going to be the question is, what does the trend line look like?
Right, exactly. And that's certainly something we're watching out. You mentioned Squid Game, and that headline certainly caught my attention. It says Squid Game had 1.65 billion hours viewed in 4 weeks.
That is incredible. Really incredible. And again, I don't know. I had to stop watching it. It was just really graphic. I know some people are into apparently a lot of people are into that, but too much for me. I think my husband stuck it through till the end, though.
It's kind of why I couldn't do it either.
Yeah.
Shares of streaming companies, Walt Disney and Roku dropping in post-market trading today after that Netflix report. We do want to point that out. We've seen Disney down about 2.5%. Roku was down about 4.1%. Netflix talking about paying down debt. So this is kind of what they're planning to do in terms of maybe how they manage the business. Gross debt, by the way, $15.5 billion at the end of 2021. But we get it, right? It costs a lot of money to get content.
And it's interesting to see that. I mean, I imagine corporate bond traders will be looking at that closely because Netflix, if I remember correctly, it's on the cusp of being upgraded to investment grade, still high yield at the moment. It could be what's known as a rising star. Expected to be one of many this year, but I would imagine paying down that debt would go a long way towards that credit rating.
Yeah, it reduces their debt costs, their debt management costs. Hey, the stock's down about 11.7% here in the after hours. All right, let's get another check on some of the top business stories on this Thursday. Also, that news after the close, including Netflix. Let's toss things over to Charlie Bella.
Hi, thank you very much, Carol Master. What a day on Wall Street. Steep losses right to the numbers here. The Dow, NASDAQ, S&P, and NASDAQ 100 index all declined today. Moving into the 3 o'clock hour, we had stocks higher, but we ended with losses, steep losses, with the S&P down 50, down 1.1%. The Dow down 313, down 0.9%. NASDAQ lower by 186 points, a drop of 1.3%. 10-year yield 1.81%. NASDAQ 100 index moving into so-called correction territory, down 1.3%. Spot gold down 0.1%, $18.38 the ounce, while West Texas Intermediate crude lower today by 0.1%, $86.90 for a barrel of WTI. Stocks turning lower, mirroring late-day moves this week as investors cut holdings in riskier assets. Big story after the closing bell, one that we're all over. Netflix plunging now by 14% after our subscriber outlook lagged estimates. It sees first quarter streaming paid net change of 2.50 million. Estimates were for a gain of 6.26 million. Also revenue 7.9 billion. Estimates were for 8.12 billion. Again, worth repeating, Netflix now lower by 14.1%. Recapping steep losses for stocks, S&P down 50, lower today by 1.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Carol Masser, Katie Greifeld, we are Bloomberg Business Week on this Thursday. Hey, Katie, I don't know if you saw this. A story caught our attention. It's about Greenwich home listings plunging to a record low in the fourth quarter. So we've seen kind of a buying frenzy in Greenwich, but apparently it's slowing down big time.
Yeah, it's interesting to finally see some of that. I mean, you have to wonder if it comes back to supply, because, I mean, that has been a theme in the housing market, that demand is there. There's just not enough houses to sell.
Well, let's see what our next guest has to say, whether she's running out of supply. She has been involved in selling homes for 3 decades and apparently spent some time on a flight with our co-host Tim Stenovec and his 1-year-old son at the time. I believe it was a red eye, and Tim says she was a gem and made the flight so much easier. Let's bring in Louise Phillips Forbes, real estate broker at Brown Harris Stevens. She has achieved more than $4.5 billion in sales over her career and closing as many as 200 deals in a single year. She joins us on the phone in New York City. Louise, so nice to have you here with Katie and myself. And Tim does send his regards and was very sorry that he couldn't be here.
Well, it is all good. I am grateful to have a little girl gang today. No offense, Tim.
Deal. Hey, listen, you have seen a lot of real estate cycles, highs, lows. How would you describe the cycle that we are in right now? What are you seeing specifically from your client base, and do you have enough inventory?
Absolutely not. And, you know, in the middle of the pandemic, nobody ever thought that we would be saying that, whether it's a rental, a townhouse, or a development project. And I will say that it is, you know, exciting to sort of watch this fast-moving market because of lack of inventory.
And at what point does this turn into almost a buyer's strike? That, okay, there's not enough inventory, you're seeing prices skyrocket. When does demand simply cool down because prices on these homes are too high?
Well, you made an observation earlier in your, you know, talking about the prices plummeting in Greenwich. And, you know, honestly, I think that is a very, I would be careful to be reporting the numbers are the numbers. But also you have to remember, sometimes you get things picked over and the cream of the, you know, the best of the best is selected. And when you have something that's been dormant or not on the market, you bring it on and you try to capture your next door neighbor's price, which is a very different asset.
Well, it's interesting. All right, so talk to us about, you said you don't have enough inventory. It's kind of exciting to watch this fast-moving market because of that. So who's buying? What's the movement we're seeing? What kind of properties are you seeing being bought, sold? Tell us a little bit about it.
Well, I think what's the thing that is so exciting, and again, 3 decades, I've had my seatbelt fastened after September 11th, after the financial crisis. A global health crisis is a very different recovery, and nobody knows psychologically or financially what that's going to look like. So my experience is that we are witnessing across almost every sector, whether it's a $57 million deal at 220 Central Park South to 33% of first-time buyers purchasing and can afford to actually own cheaper than what it costs for them to rent, is a spectacular thing to experience. The buyers who are go ahead.
No, you go ahead, please.
Well, I was just going to say that I think it's also in the last 6 months, I have watched the toes poking with our foreign buyers, and I think they're going to be seizing our development opportunities that have been lagging, the projects that have the last 10 or 15% of their projects. They're going to be absorbing those. And I think that's something that I'm already experiencing that, doing deals from South Korea, Mexico, London, people coming back to the market.
And I want to wrap in mortgage rates to this conversation, about home buying, because you are seeing mortgage rates really start to move just in the past couple of weeks. I think a 30-year loan, the average rate is now just about 3.6% or somewhere under it. People see mortgage rates going higher and they get a little bit nervous. Carol already knows that I am certainly not looking for a home right now. Would like to one day. I mean, for potential first-time home buyers looking at these rates, I mean, should they lock in a mortgage now? Are rates only going higher?
I think that would be fair to say. I mean, I came into the business 32 years ago and interest rates were 12.4%. So for me to borrow $100,000, it was about $1,200 a month. And today, you can get for less than $400 a month a $100,000 mortgage. So I think that the buying power is one of the things that when you have a crisis, which we've been in, our government has utilized the interest rates to fuel our economy, and it has done so. It's got people off who saved all this money during the pandemic. God knows we didn't go anywhere. And we saw the refinance and the origination of the mortgages to be $1.61 trillion, and we're projecting more than that for 2022. But we'll see if interest rates become those climbing, if that's going to scare people off or create a sense of urgency.
So, okay, so it sounds like true blue New Yorker, at least you've been here for a long time, in terms of the cries of, okay, the big urban areas, nobody wants to live there anymore because of work from home. I talked with Chuck Robbins of Cisco. They've been hybrid pre-pandemic, and, he says one of the things pandemic, that one of the great advantages is that you can work anywhere and you can hire employees who want to live anywhere. What of the pandemic, though, is changing the housing market in a city like New York?
Well, for true blue New Yorkers like myself, those people who, bought my house in Woodstock or tried to buy my house in Montauk or the Hamptons in Bridgehampton, a lot of people fled and they're like, holy moly, it's winter and what am I doing here? Nobody's here. Or they really are missing the pulse of the city. And I do believe that we have been experiencing, and you can see from the surge of the transactions last spring, we couldn't even process the deals fast enough. I mean, it was, and those were people that were previous owners in New York or people who've been renting, saved enough money, and they're first-time buyers. So I believe that we are going to, and again, if we talk about work from home, I mean, I'm married to a serial entrepreneur, and
right.
yes, there are a lot of people that can utilize hiring in New York, local tech firms that can hire people in other areas, but your core team, and you're seeing this.
Hey, Louise, hang on. Louise, hang on for a second. I've got to do a little bit of news, but we'll come back and continue with Louise Phillips-Forbes over at Brown Harris Stevens. She joins us on the phone in New York City. You're listening to Bloomberg.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week. Carol Massar along with Katie Greifeld. And Katie, I do have to say that one of the things I am curious about longer term is what happens with commercial residential real estate, really when we get fully away from the pandemic.
It's a great question because, I mean, the return to normal, for a lot of people, normal now is working from home, not going into an office, not necessarily going out to shops either, spending online. So, huge question there.
It's amazing how you don't have to leave your home almost for
I love it. I love
it's a little
it.
scary. All right, and those Squid Game viewership numbers show that. Hey, we're going to get back to Louise Phillips Forbes in just a moment. She's over at Brown Harris Stevens. Right now, though, let's check in once again with Charlie Pellet. Hey, Charlie.
Well, hello there. Keeping an eye on Netflix. It is the big after-hours story. Shares now plunging 20% down after hours on Netflix. It expects to add just 2.5 million subscribers this quarter, falling short of Wall Street estimates, suggesting the streaming giant is entering a new phase of slower growth in 2022. Here's Bloomberg Intelligence Technology and Media Analyst Geeta Ranganatham.
The street was kind of looking more at first quarter additions of about 6.2, 6.3 million, which would kind of then set the tone for the whole of 2022. We're looking more at like a 2.5 million, which really now kind of, I think, adds to a lot of nervousness amongst investors.
And again, a lot of nervousness after hours with that stock down by 20%. Netflix plunging after hours. A down day on Wall Street, that's putting it mildly, with the Dow, the S&P, NASDAQ, all of the damage coming in the final hour of trading. At one point, the Dow was up 461. It ended with a loss of 313, down 0.9%. To underscore, all of this happened in the final 60 minutes. Today, we had the S&P down 50, a drop of 1.1%. NASDAQ down 186, a drop there of 1.3%. So the volatility that's gripping U.S. markets this year, tightening its hold today with a late session plunge, sending the NASDAQ 100 index into a correction. Ben Kirby is co-head of investments at Thornburg Investment Management, and he was our guest right here on Bloomberg Business Week.
The volatility today is just an indication of what's going to come for the rest of the year. There's a lot of cross currents, and we have, a very strong economy, but we also have, tightening monetary conditions, and I think we're going to have a lot of chances to pick stocks and a lot of chances to either add value for clients or destroy value in the next few months.
And again, we've got the 10-year at 1.81%, spot gold down 0.1%, 18.38 the ounce. West Texas Intermediate crude down 0.1%, 86.90 a barrel. Recapping after earnings, Netflix plunging by 20%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. Still with us is Louise Phillips Forbes. She's a real estate broker with Brown Harris Stevens. She's with us on the phone from New York City. And Louise, like Carol and I were talking about, commercial real estate, really interesting time with this pandemic. What's the future there? Because, as we were saying, a lot of behaviors have changed when it comes to where people are working, where people are shopping.
I'm not an expert at commercial, but what I am an expert is at people, and commercial deals are going to bring people continuously. And if you look at venture capital money that we saw invested in local tech firms in New York, including my husband's company, last spring, they closed over $12 billion of local tech venture capital money. That is going to bring people. And you look at companies like Noom. I never heard of Noom 3 years ago. They took 115,000 square feet from Brookfield. Take a look at the top big four, Amazon, Facebook, Google, Apple. They gobbled up 3 million square feet. And what that brings is people. And we're projecting, listen, during the heart of darkness, I saw probably every appointment downtown in the East Village with somebody relocating from LA or San Francisco, from tech firms to New York, and they want a piece of the apple.
Well, at the same time, Louise, what we are also seeing, it's not just Elon Musk who's moving to Austin or who's moving to other places in Texas, or financial firms moving to Florida. We are seeing, for a society in America that hasn't moved around a lot in the last few decades, they've kind of stayed put. We are starting to see more movement. What are you seeing along those lines when it comes to your market, your residential clients?
I mean, listen, we have been hearing about, everybody's moving to, it's going to be like mini Miami, it's going to be little New York. Because people are wanting to benefit from lower taxes. And I think that is going to be normal sort of transitions that we're going to experience. But listen, I think tech is 10.5% of our GDP across the nation, and it's going to continue to affect and drive other cities, whether it's Portland, Oregon, Austin, Texas, Nashville, Tennessee. I mean, it's had over 12% growth year over year. I'm from Nashville. I don't even recognize it. And I think that there's enough for all of us to continue experiencing this wave, and people are going to look for lifestyle. It's just going to be what's an opportunity for one, and what's right for one might not be right for another individual, but companies are going to be looking for opportunities. We could look at Amazon as a case study that we didn't get that big deal that they were trying to put together, but they still bought a big asset in the build, and they are bringing thousands of employees here.
And Louise, we've talked a lot about buyers, but I want to talk about the other side of the deal, the sellers. I'm curious, have you seen people, choose to sell their house, their property now just because the market is so hot? And I mean, we've been talking about the fact that there isn't a ton of supply of houses right now for a while now. I feel like, it's really become a part of common conversation, even outside of Bloomberg HQ. So I'm just wondering if that's brought some sellers off the sidelines.
I think my experience and what I'm witnessing in the conversations that I've been having since the peak of the pandemic, when people were not sure, should I stay or should I go, that we are now clearly have a lack of inventory, and that they are owners that I'm hoping that I have them now ready emotionally, financially, to seize the moment, because it is their market. They can call the shots a little better. They still have to be priced properly because the market's still incredibly efficient. And those houses in Greenwich might not be selling because actually they're just not worth it.
Okay. Hey, listen, great to check in with you. Louise Phillips Forbes, real estate broker at Brown Harris Stevens, joining us on the phone in New York City. Fascinating to hear that it's a pretty dynamic market. And we know that there's still building going on.
Oh, yeah. It's just, I don't know. It seems like houses, they take a while to build. At what point does we do see this supply crunch get alleviated? I'd have to think it's a couple of years.
Yeah, exactly. All right, you're listening to Bloomberg Business Week. Carol Massar along with Katie Greifeld. I do want to get another check on world and national news. For that, Nancy Lyons standing by. She is in our D.C. newsroom. Nancy, take it away.
Thanks, Carol. U.S. Secretary of State Antony Blinken is enlisting help from our allies to address any possible Russian aggression in Ukraine. He's been meeting today with leaders from France, Britain, and Germany.
The goal that we share was to seek a diplomatic path to de-escalate tensions caused by Russia's massing of troops along Ukraine's borders, to deter and prevent a further Russian invasion or destabilization of Ukraine.
Blinken says the U.S. and our allies are bound together by what we care about in the world. Next, he'll be heading to Geneva, where tomorrow he's set to meet with Russian Foreign Minister Sergei Lavrov. President Biden is not giving up on his signature economic proposal, the Build Back Better plan, but he admitted during yesterday's news conference it will need to be broken up to get through Congress. Top White House economic advisor Brian Deese says there are pieces that have a chance.
The clean energy provisions in this bill will not only make it easier and cheaper to deploy clean energy and address the climate crisis, it will reduce energy costs. The child care provisions in this package will not only reduce child care costs for families, but help people get to work. The health care provisions will improve health for our families, but also lower costs.
National Economic Council Director Brian Deese speaking with Bloomberg Surveillance. More Americans are filing for unemployment benefits. The Labor Department says there were 286,000 initial claims filed last week. The biggest jumps for the week were in California, New York, and Texas. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much. So Charlie talked about this story. It passed on the Bloomberg a little while ago, but Katie, this is among our most read stories. It's about the Federal Reserve taking a key step in weighing the creation of its own digital currency. It's a move, it said, it could help ensure the U.S. dollar's dominance as the central bank grapples with fast-growing private cryptocurrencies and coins issued by other nations. We're seeing other countries developing and developed, kind of move in this direction. So what's the significance of this? This is, I feel like, your world.
Yeah, this is a report we've been waiting for a while. And like you said, other governments have taken this step, have been exploring their own central bank digital currencies. They're known as CBDCs. And also, there's a lot of private competition, too. I mean, if you think about, privately issued stable coins, Tether, Circle. So this is something that the Fed has been thinking about for a long time. We've been waiting for this paper. We knew that they've been hinting that it's coming soon. We finally have it. It's 35 pages. But, there's a lot of steps here between now and when we actually see the Fed or the U.S. government issue its own digital currency. It still has to get support from the White House and Congress. So we'll see where this goes. But it is not the first step, but an important step.
Well, and that's a really good point, right? I mean, just because, there's many steps to go. It doesn't necessarily say that the Fed is all in on this. But it is interesting, and I do wonder whether this move is, again, just kind of reactionary because of what's going on, or whether the Fed really thinks it's a good idea. We don't know yet, right?
We don't know. It does feel like, the Fed, obviously, any decision it takes, it evaluates for a long, long time. Some would accuse that institution of dragging its feet, but, this is completely uncharted territory. Cryptocurrencies, they really didn't enter the mainstream until the past decade. So, by some standards, the Fed is moving quickly here.
Right. And we know the central bank has warned of possible negative effects, including draining deposits from traditional banking, making runs on financial firms more likely or more severe. So it sounds like a lot more discussion will certainly happen when it comes to the Fed. You're listening to Bloomberg Business Week right here on Bloomberg Radio.
Connection lost.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Steep losses for Netflix, plunging 20% after hours following an earnings miss. The tech-focused NASDAQ 100 fell into a correction today. A lot of selling in the final hour of trading today. The NASDAQ 100 index down 1.3%. NASDAQ Composite Index down another 1.3% today, bringing its January loss to 9.5%. S&P down 50, down 1.1%. Dow Industrials down 313, down 0.9%. 10-year yield 1.80%. Spot gold down 0.1%. 18.38 the ounce. West Texas Intermediate crude down 0.1%. 86.90 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. Well, this week at Bloomberg's The Year Ahead Summit, just yesterday, in fact, I had an opportunity to talk about the world of technology and just the world generally with Chuck Robbins, Chairman and CEO of Cisco. We did talk about a lot, that macro outlook, which of course included today's current health pandemic. Listen to this.
I think that, we went into 2021 with high expectations, and unfortunately, we came to realize, to your point earlier when we were chatting, when you think we're moving on, we get surprised and realize how little is in our control at the end of the day. But I think this year, we're hopeful that that Omicron is the signal that we're getting close to the end. When you listen to the medical experts, they at least insinuate that may be the case. Obviously, there's a risk of other variants, but I think people are ready, and I think they've been ready, as we all are. And as much as we love this technology and we're so proud of what it's been able to do to keep the world running and keep people productive, I think people are dying to get back and spend time together and be in person.
What do you think in terms of the general macro outlook? How does it feel? You know what we've been talking about. I'm sure you guys have too. You have certainly on some of the earnings calls about supply chain problems and being able to access, all the materials that you need. How does it feel? And does the economy feel like it'll be growing, but maybe not as rapid as we'd like?
It's so hard to predict because I think if you go back to March of 2020, most all of us thought that as we went into a global pandemic that the economy would suffer. And we saw just the opposite over the last 2 years. And so there's a couple things I think that are going on. Number one, the year-over-year comparisons will just make it very difficult because 2021 was such a robust year. And then I think obviously the Fed is going to move and begin to raise rates, which will have some impact on the economy as well. But I think that, the investment cycle that companies are in the middle of and how they're thinking about technology investments and how they're thinking about their future, it seems to be a pretty robust investment environment that we see, and particularly in our space, we see some big long-term trends that we think will continue to be tailwinds. We may see some ups and downs because of temporary macro issues, but I think long-term will be fine.
Cost pressures, though, inflation, labor shortages, that's still part of 2022, unfortunately?
Unfortunately, that's true. And, as so many of us have said, some of that stuff is going to be transient, but a lot of it's not. I mean, wage inflation doesn't go back. I mean, I joke with our team. I can't remember an employee when things get, when inflation subsides, they come and say, I'd like to get part of my salary back. So, I mean, whatever we're having to do on that front will stay with us forever. But, the good news is that what we've learned around hybrid work and what's possible, where people can live, it gives us the ability to tap into lots of different geographies and hire people where they are and actually get exposure to much greater talent pools.
Chuck, talk to us about hybrid work. You guys at Cisco have been doing it pre-pandemic, and so have a lot of firms in the technology industry. There is a huge debate out there still, and you guys have certainly seen the benefits of everybody needing to be connected. I'm working at home again for a week or so. Does that continue? Is that with us? Is that one of those long-term trends? It ain't going away.
It's not going away. And I think, we're going to a certain extent, we're going from this great resignation to a great experiment, right? We have, I speak to many of my peers. I was together with 8 or 10 of them yesterday in Washington. And before the session, we spent time saying, well, how are you thinking about it? What are you doing? How are you handling this? So there's these variations of hybrid work that everybody's trying to embrace. And, we have 2 aspects. Number one, what are we doing as an organization, but also the technology that we build that's actually enabling our customers to deliver on whatever version of hybrid work they would like to deliver on. But to your point, we had 10 to 15% of our workforce that worked from home 100% of the time before the pandemic. And I think that the way we're approaching it is we're leaving it to the team. So we're not having any sort of mandated return to office policy. We will let the teams know when the offices are open so you can return to them. But as an example, if there's a team of 8 or 10 engineers and they believe that being together in person 2 or 3 days a week is beneficial, they'll make that decision and then they'll choose the days that they want to be in the office together. And we think that's a better way than just a random, hey, we want everybody in the office 2 days. It's just not all that logical to me, but we'll see how it plays out. And we'll see which of these models actually begins to emerge. But we think the approach we're taking gives flexibility, gives our employees flexibility. Many of them can live wherever they like. Obviously, there's some jobs that are going to be required in a certain geography, but we think it'll just continue to contribute to the culture that we try to build.
Yeah, we're definitely seeing Americans and people all over the world kind of being able to move around. I am also curious in terms of innovation. This was one of the things we talked about during the pandemic, and I'm thinking about, we're looking at the year ahead in technology. I think there were folks saying, well, wait a minute, would Zoom have been created if we were in a pandemic environment where people weren't together, maybe in a room? What would you say for a company that's been, on hybrid working, for years? What happens to innovation and disruption and being able to figure out new ways of doing things?
I have to say, I was amazed during the pandemic at the level of innovation that we were able to drive and that many companies have been able to drive. I knew we could be productive because we build the technology, we do it, we use it. So I wasn't all that concerned about that, but I really was worried about how much innovation are we going to be able to drive with our engineering teams, spread apart. And they did an amazing job. And so many companies did an amazing job. The great news is that government leaders around the world, CEOs, CXOs, all experienced this technology up close and personal in ways that they hadn't in the past. Right? Most CEOs didn't do a lot of video meetings. And now I have my peers who are saying, I can't imagine a world where I take a 12-hour flight for one meeting and then come back. It's just not going to happen. And so I think they realize that this technology has an incredible power. No one expected the world to remain as productive as we were during this time, which says the technology is really powerful. And I think that after having experienced it up close and personal, I think they're much more open to looking at how do we accelerate the use of technology across various aspects of our businesses, which continue to lead to different, the need for innovation and creative thinking, which I think is happening at an accelerated pace.
And that is Chuck Robbins, the chairman and CEO of Cisco Systems, speaking to me just yesterday at the Year Ahead Bloomberg Live Summit. Hear that full conversation? You can do so by heading to BloombergLive.com. Really great to check in with him. It is fascinating to hear, you talk to those tech firms. They've been doing the hybrid work for a long time. They're kind of cool with it.
Yeah, and I mean, you really covered a lot of ground, but that comment at the end about how, executives, they don't necessarily want to hop on a plane and travel thousands of miles for one meeting anymore, that's a thing of the past. Have to think that's not great news for the airlines. I mean, business travel, that's another huge question mark. Is it ever going to come back to the level that it was? I mean, listening to Chuck Robbins, it doesn't sound like it.
Right, and you think about bosses, you're going to be like, do I really need to pay for you to get on a plane, sit in a hotel, and have a really good steak dinner with a nice red glass of wine? Probably not.
Those expense reports, they might be looked at a little bit more closely. Again, not great for the airlines. I also really liked those steak dinners, but we'll see.
Me too. The glass of red wine isn't too shabby either. I agree, though. I think it's going to take a few years to really understand what stays with us and what rolls back. All right, Katie, always good to have you here. You're going to be with me tomorrow?
I don't know. It's really up to Tim Stenovic. We'll see.
We'll see what he's doing. All right. Everybody have a good and safe evening. This is Bloomberg.